Trading versus investing. Now, it sounds pretty similar, and a lot of people use those terms interchangeably. And that's why in this video, I want to really clarify what are the differences, which one is better for whom, and which one might be best for you personally, because it's one thing what some people choose, but ultimately we all have to make our own decision. I think that's very important to find what works best for you, because those two different ways of investing are very much different paths to growing the wealth. Both ways have the idea to grow your wealth, right? To make more money out of the money you have already. So that's the main essence between both of them. But apart from that, they're very much different. So let's talk about it and see what is different and which one might be best for you. I was just in the middle of preparing a presentation on Canva to walk you through the differences when I came across a great article from Trading 212 about this topic. So I might actually just go through this and use some of the great graphics that they have produced to really explain the difference between the two, and hopefully it makes it more understandable. And of course, being a Trading 212 user and investor myself, I really recommend the tool and platform. I invest my own money over there. And if you want to try Trading 212 for yourself, then use my link down in the description below and you'll get a free share valued up to 100 euros. And the first major difference that this graphic beautifully illustrates is, of course, the difference in speed. That's pretty obvious, but there are obviously way more differences. But the biggest one is definitely the speed of growth that people look to grow their money. When you trade, you're basically moving in and out of the markets, even sometimes in a matter of seconds or minutes, multiple times during the day. Now, on the flip side, when we talk about investing, that's really a long-term process, building wealth, many years, decades even, over time to start compounding your wealth. So very much different mindset and approach. So it's really a difference in time horizon. When you trade, you move in and out constantly out of the markets. And let's be honest, most people doing that are either doing this full time or spend a lot of the time to dedicate to that, because you can't just passively do this on the side. Whilst investing can be much more passive. You can even automate everything and don't have to look at it ever again. You just set it up once, set and forget it, and every week or month you buy more of your share or ETF. We'll come to this a bit later. It's just investing on autopilot, whilst trading is very much active. You want to be involved, you want to know what's going on. Sure, there are also copy traders where you copy other traders, but here we're talking about active trading, and that really involves actively following the market, doing technical analysis, and really spending time in the charts and understanding what's going on and moving in and out very quickly. Here you see a number of things that people do trade, and I would say a couple of them are really most commonly traded. The first one being Forex. Foreign exchange, basically, you trade different currencies with each other. For example, euro with dollar, dollar with yen, whatever you want to. That's very popular. And a lot of people, they trade currency. When one goes up, they sell the other, and it's just in and out of positions, basically. Another one, obviously, a lot of people know and think of when they hear about trading is shares, right? You buy, Nvidia, you buy it, you sell it a little bit later after you made a profit, and you move in and out very quickly. And once again, of course, you have many other things that you can trade. Some people trade commodities, others trade bonds. Of course, cryptocurrency is yet another very popular trading asset class, because the great thing here, it's available 24/7, 365 days a year. The crypto markets are never closed, unlike stock markets, which are closed on the weekend. That's why a lot of people and younger people like to trade cryptocurrencies. Of course, you can also trade ETFs, indices, and even interest rates. So a lot of different things that you could be trading. Now, there are a couple of terms that you should be familiar with when you talk about traders. And the first one are position traders. So here we talk about people taking a position in any of the above asset classes that I just talked about and holding it for a couple of months up to 1 year. So definitely less than 1 year. Anything over a year we typically call as an investment or investor, but anything under a year, as I said, a few weeks, month, up to 1 year, that's a position trader. That's also quite popular, less frequent, so it might be a little bit more passive than some of the other styles, but that's something very popular, many people do. Then we have the swing traders, and here you talk about holding a position from a couple of weeks to a couple of months. So that's also very popular. I know quite a few people doing that. They have a feeling that something might go up, so they buy it now at the low, waiting for the price to appreciate in a few weeks, and then sell and then pocket the profits, hopefully, if they make some. So that's, I think, one of the most popular trading strategies. Then, of course, you have the day traders. So as the name implies, these are the people who go in and out in a position during the day. So they might buy it in the morning, hold it until the afternoon or evening, and then definitely sell before the end of the day. And that's very popular. You see a lot of YouTubers doing that and selling their courses and driving their Lamborghinis from all the successful day trades they've been doing, while often actually the money comes from selling you the courses rather than the extra profits that they make sustainably over time, especially with influencers and younger people online. They talk about day trading. Now, the next one is scalping. So here we talk about holding a position for a couple of seconds to minutes. So literally less than a day, less than an hour. So really just a few seconds up to 1 hour, you move in and out very, very quickly into those positions. And lastly, HFT or high frequency trading. So here we talk about, as the name implies, really, really high frequency, literally a couple of seconds, even milliseconds. When you look at some of the big investment firms, they're investing millions into building up the infrastructure so that they have the fastest internet connection, computer connectivity, that they can move in and out of positions. If you do this multiple times, hundreds, thousands of times during the day, those little cents that you make every time you trade can really start adding up into some major returns. Now let's move on to investing. And here we talk obviously about more conservative investing styles. And most popular is of course bonds, where you buy the debt from government or companies and you hold their bonds. You hold it for many years. They have a maturity of 10 years, 20 years even. You lock in the interest and you know exactly what you're going to be getting back. You can also invest your money in money market funds, which is a very predictable return that you'll be getting. Now you could also take a bit more risk and invest into individual companies and hold that for many years, right? People who invest in Apple or Microsoft, 10, 20 years ago and believed in the company and were holding on to them for so long. These are long-term investors. And of course, like myself as well, I'm a big believer investing into ETFs, especially the S&P 500. So that's really long-term investing to see the compounding effect over there. Now, when we talk about investors, there's also different styles of investors. You have the active investors. So these people definitely have a long-term horizon, but they're more involved in looking where they can maximize their returns. They're looking at the numbers every week or every month and see how the investments are doing. It doesn't mean that they move in and out of positions, but they just want to keep on top of what their portfolio is doing, how things are going along. And if they don't see success with one investment, they're not afraid to move that money into something else. But of course, they do that with a long-term mindset. Then the next group of investors, these are the passive investors. And honestly, that's something I'm a big advocate for. And I would call myself also partially passive, partially active, but more on the passive side, I would say. And that's, for example, when you invest into an ETF, right? Exchange traded fund. You choose one that resonates with you. I made many videos about this. There are many different funds that you can invest in. I like the S&P 500, but again, there are amazing different funds that you can invest your money. You could automate everything, set it and forget it. And then basically the investments just take care of themselves. Just continue to put money into those and over time they will grow for you. So that's really passive. And a lot of people, that works perfectly well for them. And I always recommend that because you want to focus on, living your life, spending time with your friends and family, growing your income so you have more money to invest, rather than trying to outsmart the market. So I think that's a popular investor group. A lot of you watching probably will fall under this, and something I'm a big advocate for. But again, of course, there's no right or wrong. Once again, we'll come to this a little bit later of the video, but I think it's a great way to get people started with investing and growing the money. Then also we have the growth investors. So these people really invest into high growth stocks, again, with the long-term time horizon, but they're really willing to take more risks. So they invest into AI chip companies, for example, or tech companies, or instead of investing into S&P 500, they put all their money into the NASDAQ 100, which is a much more tech-heavy index, and you can buy an ETF based on that. So I think people are really looking for growth. Yes, they understand there's also more risk to it, but they're really looking at growth. And especially if you're early on in your investment career, that might be lucrative to grow it until you have a larger portfolio, and then you can be a bit more maybe conservative and become a bit more passive investor. So it's really up to you. And the last group is the value investors, which Warren Buffett really made popular. And he's a big believer in buying a company that is undervalued, that you see undervalued, and you see long-term price appreciation of them. And that's why, for example, he bought Coca-Cola, right? It's not a particular sexy company that we're going to think is going to 10x in the next 2, 3, 4 years, right? It's quite a conservative and predictable company, but it's a cash flow machine generating income for the investors through dividends, through price appreciation. So a lot of people looking for those value plays, buy something when it's cheap and then stick with it over the years to see the appreciation taking place. Let's talk about the actual differences between investing and trading. But before we do, if you enjoy these kind of videos and want even more deep dive into those kind of topics and deeper discussions and be able to also DM me and ask any questions, then you might be interested in checking out the Smart Money Club, which is basically my club and community where we really go deep on all the various topics. And yeah, we have weekly calls over here. Members can post any questions they want. I really share any important updates in the markets that are going on. We have a knowledge base over there as well. I make regular update videos for members only. People can also share their portfolio and ask any questions they may have. And I even make videos where I show all my income and spendings for particular months to show how much I earn in a given month. And I think that's really helpful for the members who've been there. So if that sounds interesting to you, then check the link down in the description below. And I'd love to have you as part of the club. Right, so as a summary, let's look at the differences between trading and investing. Now, the first one we spoke about before is the time horizon. In investing, we talk about anything over 1 year. up to 10 years, but usually it's even 20, 30, 40 years, right? The younger you are, the better it is. It really, time can be your best friend or worst enemy. If you start investing at 50, it's still not too late, right? If you plan to live to 70, 80, 90, you still have many, many years ahead of yourself. But obviously, the earlier you start, the better you can benefit from compound growth over time. Now with trading, it can be all the way from seconds holding a share or cryptocurrency or whatever you trade, up to a maximum of 12 months. Anything beyond that usually is considered investing. Now, the next point to talk about is leverage. And that's basically when you use money that you don't actually have. Now, investing, that's not really very common. In trading, it's actually very common. So basically, a trader would put 1,000 euros or dollars from his side, and then the bank or brokerage can match that. So you could borrow at margin, basically, up to 50%, in some cases even up to 100%, so you can double your tradable amount. So if your gains are 1 or 2%, you can double basically the return by having more money, right? At the same time, that comes as a risk, because if the trade doesn't go in your favor and goes down, you start owing the bank or the brokerage some money, and they might close your account and liquidate you, and all your assets and belonging will be gone that you had there. So it's very, very high risk versus high reward. So using leverage can really boost your earning potential, but at the same time, it obviously is very risky. Now, talking about risk, obviously, with investing, generally, I would say it's low risk. Now, obviously, you can also invest into something highly volatile, speculative, right? If you only invest into high growth tech companies that have no revenues or profits yet, but you think they will in 20, 30 years, that can still be very risky, right? It doesn't mean just because you hold it over 1 year, it's less risky. But generally, if we generalize investing for a longer period, you invest into something that has a solid track record, like an S&P 500 or maybe another global world index that has a proven track record, it is definitely less risky than if you put all your money with the leverage even into a trade that you hold for a couple of seconds, which can go up, but also within a couple of seconds, there can be a flash crash and all your money will be gone in a matter of seconds. Personally, I just don't have the stomach for that. Now, in terms of investing frequency, most people who invest for the long term invest usually, I would say, on a monthly basis, or some people also choose to do it on a weekly basis, like I do myself. I invest every single week. But of course, monthly basis works just as well. I wouldn't recommend anything beyond that, because if you invest only every 3 months or 6 months, you don't really benefit from dollar cost averaging, where you get the best average price. So I think the more frequent you do it, without doing it too frequently, you don't want to be doing it on a daily basis, because you should also consider commissions, right? The more often you trade, the higher your commissions are, unless you use a stockbroker like Trading212, where there's no commissions, but many others, they do charge you commissions. So that's something to keep in mind as well. In terms of how active or passive one is, obviously with investing, usually, again, on average, it is more passive, where you set it and forget it, or even if you do check your portfolio and maybe move in and out of certain positions, it is definitely much less active than with trading, because here you're really involved. If it's a day trade, you really want to be there and check what's happening every single minute of the day to make sure your trade is going the right direction. And if not, you can action. So it's very, very active. This is not set it and forget it for sure. Now, in terms of success win rate, there have been countless studies that kind of took average investors and average traders, and over the long term, well, the average success win rate is definitely higher with investors than with traders. That's just purely statistics. Now, of course, there will always be exceptions. There will always be great traders. But on average, if you think you can outsmart, big firms, people invest millions into trading, scalping, high frequency trading from the comfort of your couch with your Wi-Fi, a coffee in the hand, and try to outsmart them. Personally, I think it's just not possible. You might get lucky a few times, no question, maybe a year, but over a longer time period, I just don't think you're going to be outperforming the market in general. And again, it might be a better way for you to be a long-term investor. Now, in terms of returns, obviously it depends what you're investing in or trading in, right? As I showed you before, you can invest into bonds, for example, where the returns are definitely lower, but you could also invest into high growth tech stocks where the returns are higher. So on average, they're saying anywhere from 5 to 20%. The S&P 500, which for me is kind of the market returns, on average over the last 30 years, the S&P 500 returned anywhere from 8 to 10%. So for me, that's the kind of average return that I am, as a long-term investor, are expecting to see with my portfolio. Versus a trader, they look at 5 to 20% monthly, right? On a monthly basis, which is crazy. Let's assume you're trying to have a 10% monthly return, which sounds amazing, right? Who wouldn't want to have that? That would equate to a 213% annual return, which is absolutely outrageous. I think some of the best investors in the world, like Warren Buffett and so on, they managed to get like a 20%, 25% return in a year on average. So that'd be 10x the best investors return, which it just shows you it's just unfeasible and really not realistic to achieve. And lastly, methodology. So basically, what's the basis of your investing decisions? Now, when you invest, As a long-term investor, obviously look at company fundamentals, right? Look at the revenues a company has, the profits, the future earning potential. You can really analyze that. You look at the company and you can make decisions based on that for the long term. Now, when you trade, you look at technical price movements. You kind of look at the charts, and based on those charts, try to predict where the price is going. And well, obviously they will tell you and sell you the courses on how to read the charts and predict the future. But the truth and reality is nobody knows the future, right? How can you predict where the price is going? It depends on so many different factors. You might want to trade a company that you believe in and the price goes up and there's a big PR disaster coming out, the articles drop, and literally in a matter of seconds, the price will start tanking and your day trade will go down the drain unless you shorted the price, of course. But yeah, basically it's really, really hard to predict in my eyes. I think by now you see the difference between the two. And I think it's very important to know the difference because people often confuse that. And a lot of brokers, they say, you can invest with us, you can also trade with us. And it's very tempting to start trading because a lot of brokers make more money on trading because even they show you the warning signs, disclaimers that most people lose money trading, CFD trading, option trading. As I said, people can make money. I'm not denying that. It can be very lucrative and profitable for some, but on average, it's just a matter of fact, people lose more money than they make. And that's why I'm thinking, why should I even try to outsmart the market? As I said before, I want to set it and forget it, long-term invest my money, rather focus my time and attention on growing and earning more money that I can then safely invest, knowing I'll get a 9-10% return over time, instead of trying to outsmart the market and big companies, which again, the chances of doing so are very odd. You might as well go to a casino and gamble, which there's also a chance that you can beat the house consistently, but long-term, most people fail. That's why the casinos keep getting bigger and the people playing in there, well, usually their wallet's getting smaller. All right, friends, hope you enjoyed the video. If you still have any questions about any of the things I mentioned today, pop them in the comments down below. I'll get back to every single one of you. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.